All right. So what we're going to look at now is just a industry by industry, or I should say sector by sector breakdown over the past month, and see which portfolios are performing the best, and talk a little bit about what our possible replacements um, will be. So for starters, let's take a quick look at what the sectors have done over the past month. Looks like the basic is up 3%, 6% for consumer durables, 6% for defensive goods. No, I'm sorry, I said that wrong. This is consumer durables. This is consumer cyclical. Cyclical. All right. Energy up 6%. Finance actually down almost a percent. Health up a whopping 12%. Uh, Industrials up 6%. Real estate up 9%. Tech up 5%. Telecom 5%. Utilities 5%. Really 6%. So it looks like everything was up pretty big this past month. Real estate looked really good. Health got a big pop. So we'll kind of take a look at that and see what's going on there. Um, and then basic materials only 3%. So they are lagging. As you see here, there's only three companies right now in our basic sector. Looks like CF has performed the best over the last year or so. Consumer cyclical Ford. We got Las Vegas Sands, Macy's, International Paper. You'll notice that what's missing here is the company that we're currently in, which is Thomson Reuters. That is because after June of this year, Thomson Reuters is no longer investable. So we're definitely going to have to come out of Thomson Reuters and look for a replacement. Looks like International Paper, which was kind of what we decided against when we got into Thomson Reuters. It was either Thomson Reuters or International Paper, and we decided to go with Thomson Reuters. International Paper has been the MVP over the past year. Macy's has the biggest return so far. And then we have some new companies here, GPC and HAS. So we'll have to do a little bit of homework on those. HAS looks pretty good as far as the average return. So we have to do some research on those to get a good idea of where we're going to go. But we definitely have to replace Thomson Reuters for sure. So we'll replace it with one of these. All right. Let's see, not worry about defense really. Energy, finance. Take a look at finance. Finance looks like over the past. Let's take this back here. Let's see. BX up 14%. My goodness. BBVA and IVZ down almost 14%. So that's why you have finance down slightly. But then you also see MFC here down almost 4%. MetLife down almost 2%. And so I have to imagine, yeah, SLF, another insurance company. So the insurance companies are down a lot. They're down a lot. And a lot of that has to do with interest rates. And so typically speaking, the finance sector itself, banks and whatnot, they really make a lot of money when interest rates go up because they're able to make loans at a higher interest rate, and typically their investments will also increase with the higher interest rates because all they do is basically bring in money and then put it into the money market or government bonds, things of that nature. And so as interest rates increase, they're able to get a bigger return on their money. So that's the reason why we see companies like BX, which is an investment bank, up so much over the past month, and on an average 2% a month. I mean, that's huge. Uh, another thing to point out is that the company that we're currently in is TD Ameritrade. Our broker is also TD Ameritrade, but as you see here, TD Ameritrade is not on the list of investable stocks. And again, that's because, over the course of a year, they're no longer investable for us. So we'll have to switch out TD Ameritrade as well, and we'll look for a nice replacement. BX right now looks like the strongest choice, but we'll take a look and see what other portfolios have performed well and make sure we're doing the right thing there. All right, so health is another big one. It's a big pop. Looks like Pfizer, CVS, Merck, BMY, not sure who they are, Johnson & Johnson, IEP, I saw it down here, Johnson & Johnson. They up real big this past month. And so that's a lot of the reason why the health sector has jumped as much as it has. We are currently in Pfizer. As you see, they are leading the bunch as far as average return. We don't have a lot of shares in Pfizer. It is one of our what I call legacy stocks. It's a stock that we started off with about 3 years ago. Well, 3 years ago exactly, actually. And so we're just kind of hanging on. We've been collecting dividends. It's performed well. Like I said, the price has not moved much at all. We bought in, I believe, at 32, and right now it's about 34, 35. So we'll just hang on to that. When the price does go up more, at some point we'll be able to sell out of it. But for right now, we're kind of stuck where we are. Industrials. I think it's fair to mention here that GE is still an investable company for us, and it's actually in MVP over the past year. And a lot of that just has to do, honestly, with the portfolio that GE happens to be in. That particular portfolio has performed well, and GE is part of that portfolio, which is why it's been the MVP, but it has not performed well at all. But we're holding on. It's a turnaround story. We'll see what happens. Real estate did get a little bit of a pop. Let's see why. See, Annaly is what we're in. That's an MVP over the past year. This past month, looks like, oh my goodness, REG, DLR. This is digital real estate. Digital real estate. They own server farms, basically just big warehouses that do nothing but hold hard drives. And so you have a lot of those server farms around the country. Companies like Facebook, Apple, they have the iCloud, where they have to have a lot of storage, use some of these server farms, and DLR owns those server farms and rents them out, leases them to companies. REG, I don't know a whole lot about. Forget the name of it, but I'm familiar with O. They perform fairly well. And we are currently in Annaly, which hasn't moved around a whole lot, but they have that nice big dividend. As you can see, the performance isn't great. A lot of that is just because of the business that they're in and the type of environment that we're in with interest rates makes a big difference there. As far as technology, again, I have to mention we are currently in Cisco. Cisco is no longer on our list of stocks that we can invest in. So we'll have to get out of Cisco and get into something else as well. It looks like technology, like I said, it was a big thing, and now it's kind of come back. Over the past month, though, you see here, 17%, almost 20%. I mean, that is something else. Intel, that's a big story. I would like to see what's going on with Intel, just from my own knowledge. They've been around forever, and they're not going anywhere, but they have dropped quite a bit. CA, look at this performance, almost 5% average a month. That is crazy. And I'm pretty sure that average has a lot to do with this big 21% bump here. Qualcomm has been dealing with a lot of lawsuits that I think they have come out on the winning side of. And then GLW looks like they've done fairly well. So the technology sector would have done much better this month if it hadn't been for Intel, I'm going to assume. Okay, Telco is doing what Telco does. We are in Rogers Communication, a Canadian telco company. We see it's jumped up almost 11%. I'm really shocked, honestly, that we didn't get a sales signal this past month. But we have maybe another, I don't know, 50 cents or $1 or something like that to go before we start seeing that sales signal. CTL is the sector MVP over the past couple months or the past year. Looks like the average return is the highest, 20% this past month. That's crazy. CenturyLink, never been a fan, but with this type of performance, especially being that it's MVP, we'll definitely have to look into it. Utilities, we're currently in American Electric Power. Looks like it's just second place, basically, from Southern, which has the MVPs 3 and Southern is 4. As far as performance, it's not terrible. These companies are doing a bit better, but I think it's right in line with what the other utility stocks are doing. Fairly nice jump, almost 8%, about in line with everyone else except for D up here. So, all right, that's interesting. Let's take a look now at our portfolios and see which one has performed the best. Blow this thing up. All right, so what we're looking for is we're looking for the highest number highlighted here in yellow. That's going to be the largest total return for the past year. Okay, so got 2.6, got 10, 9, 5, 9, it's about 9, 4, another 10, 9, 7, there's 11, so that's the highest so far, 11%, 3, oh, 12, new high, 12.84, it's almost 13%, another 11. So I'm definitely curious to see what the 12.8 is, and then maybe take a look at some of the 11s as well, because it seems like there's quite a few. Uh-oh, look at that, 13.4. So now I'm going to imagine, without even looking at this thing, that whatever portfolio is 13% is probably going to be very close to the same stocks that's in the portfolio that's 12.84. All right, so let's go back and take a look and see. So we're going to be looking at the 1340. All right, and let's see, drum roll. This is alpha and standard deviation. All right, so alpha is basically what companies perform the best when the stock market is rising, which makes perfect sense because the stock market has been rising quite a bit, and so these companies perform the best when the market is rising. And so let's take a look at what we have here. Fairly straightforward. TRP for Energy, Weyerhaeuser were there, Pfizer were there, Annaly were there, American Electric Power were there. So as far as what we need to switch, we need to get out of our finance. So BMO, that is, what is this? British something. It's a Canadian bank. And I love the Canadian banks. Tech, we got Texas Instruments. I don't know about that one. We got out of Texas Instruments not too long ago. And our consumer cyclical GPC. All right, so that's what we kind of have to look at. We have to look at BMO. We have to look at Texas Instruments. We have to look at GPC. Now, let's do this. Let's go down here and let's take a look. So that was alpha and standard deviation. So again, it means stocks that perform the best when the market is rising, but it also means that these companies do not move around a lot. The price does not change a lot. Okay, literally, just whenever the price does change, it doesn't change a lot, and so that's what the standard deviation comes from. So let's take a look at 12.84. I have a feeling that it's going to have something to do with alpha or return. I don't expect it to have anything to do with standard deviation. I can't see that being the case. Let's see here. All right, 1284, beta and return. There you go. So beta are those companies that perform the best when the market is going down. However, return simply means that these companies have the highest rate of return. So that's really interesting. I was really expecting something completely different. I completely understand why this portfolio would perform well, though, in the current environment, just because typically stocks that perform the best are going to perform the best no matter whether the market is up or down, right? Now, this is based on the previous year, okay? This is based on, matter of fact, I wish I can show you right now because I'm trying to remember myself, but this is going to be from I believe December 2017 or maybe it's June of 2017. I have to go back and look, but anyway, this is the previous year. So these are companies that had the highest return over the previous year, not recently, over the previous year. So anyway, Pfizer, we're there. Rogers Communication, we're there. And then the rest of this stuff we'll have to take a look at. So TSM Technology, HAS Consumer, BX, we've already looked at that one, right? BX for finance, that's the investment bank. I think I kind of like that idea. So we have the Canadian bank, BMO. We have the Blackstone, which is what I believe this is, Blackstone, which is the investment bank here in the U.S. To take a look at. As far as consumer cyclicals, HAS and GPC, which are really new companies for us, so I have to do some research on that. The other thing, tech, TSM. I don't know a whole lot about TSM, so I have to go see what's going on there. Let's see here, TSM. Okay. So yeah, we have to go take a look at that, and let's see what else we have here. 1284. There was another one that was close. I believe it was 12 as well. I see 11, 10, 30. 5, 10. All right, so there wasn't anything close to 12. There was a bunch of 11s though, and I am curious to see what those 11s are about. If there's a couple of them that are close to, well, my goodness, I keep getting surprised here. So dividend and up. So these are high dividend stocks that tend to move up when there's a lot of buying and selling going on. And I'm saying buying and selling, but whenever there's high volume, so whenever there's a lot of activity in that stock, those particular companies tend to move up versus down. Let's see, same thing, beta and up, companies that tend to work well when the market is down. Uh, but when there's a lot of volume, they also tend to go up instead of down as far as price. Let's see, 11. So this is really good, actually. Statistically speaking, it's really nice to have a nice broad selection. I hate it when all of the portfolios that perform the best are typically the same companies, because it doesn't really give you a lot of choice. You know what I mean? And right now, I mean, there's a lot of choice, and so alpha and up. See, so the up is about the same, right? But you throw in the alpha, and then we have the alpha standard deviation. So you see, there's some. So again, we see GPC there, right? And that's really it. Not everything else is completely different, completely different. So that gives us a lot to look at. CM, we already kind of talked about that. That was one of the highest return numbers, and that's part of this portfolio. Let's take a look here. What other 11s do we have? 11, 16. This is alpha and down, so they tend to go down less when there's a lot of volume, and they perform best when the market is moving up. Okay, all right. 16. All right, I think that may be it. 1132, up standard deviation. All right. And dividend beta and up. Makes sense. All right, so let's take a look now at our hot chart here. And what I like to do with this is just kind of look at the colors and just eyeball what looks to be the greener portfolio. Okay, so we're looking for shades of green here, and to my eye, this definitely looks greener than some of the rest. And we see an average here of 1.92, and that's the up portfolio. So let's kind of keep looking here. See, this one is really green, but really red. This one's really red. See, oh, getting into a lot of red now. Getting into a lot of red now. Oh, that's so red and so green. Let's see what this looks like. On average, this is 1.05. See, so 1.92 beats that hands down. Yeah, see, so that's it. I mean, I can't find anything. And so, what this means to me is that, like, for instance, if we were to go with this portfolio, you see, it would have been great. This is 1, 2, 3, 4, 5, 6 months. Okay, 6 months worth of returns. It's 4.6%. That's great. But then you have this 1 month here where you're losing 22%. I mean, that's and then when you factor that in, now all of a sudden your average is 0.7%. See, in 1 month, all your gains pretty much go away. So I mean, it's I think it really helps. It really helps to look at things this way. This thing, and I want you to understand too. So you see this negative 4% here, right? Well, that's a fairly large drop, but you see the color is fairly is a faint red, right? Versus this very, very bright dark red here. The reason why is because all this stuff is relative, right? This was a month in which, a lot of stocks dropped. This is March 2018, and you see negative numbers all across the board, right? But because this one fell, I wouldn't say the least, but at least, you know, not as much as some of these others fail. The color is a faint red, right? And so that's kind of what we're looking for. You know, we want a nice, smooth ride into the future. We don't want to do a lot of bouncing around. Let's look at this one too. I completely missed this one. This one is nice. This is 3.17 actually, which is way better than this thing. And then this is, look at this, beta. See, this is what happens. You know, this is October 17 to current. You know, even though the actual return, okay, is higher for this portfolio, which was the alpha and standard deviation. Okay, even though the return is higher, if we go look at alpha and standard deviation here, clearly that particular portfolio did not look good to us. Why? Well, it's probably because that alpha and standard deviation, see, did not 1.2%. 1.2% on average. So what that typically means is that it's possible that there were, you know, one or two stocks that performed really well, which made the entire portfolio perform well. But looking back over the history of this particular portfolio, I mean, the average is only 1.27. So again, more information is better. You know, we want to be able to look at those differences in performance to get a good understanding of where we need to be. You know, 3.17 for beta, which means companies that perform best when the market is down. You know, that's your protection, that's your defense. And typically those companies that perform well when the market is down means that these are companies that people don't want to leave. I mean, that's rational, right? So think about it. So when the market is dropping, it's only dropping because people are selling a lot. Okay. Well, if these companies perform best when people are selling a lot, that's only because people are less likely to sell these stocks. Probably because they're great companies, and even though the market is selling off, they're like, nah, I'm gonna hold on to what I have, right? That's a good thing. What that also means, though, however, is that these are probably companies that people don't get very excited about, because the companies that people are very excited about, it goes both ways. Emotions run high and then emotions run low. When people are not excited anymore, or when something happens, all of a sudden everyone is off the boat. See, that's the thing. You know, when that bandwagon comes along, everybody hops on. And then when something happens, guess what? Everybody hops off because they were only bandwagon members anyway. So I am inclined to go with the beta portfolio. But of course, like I said, we will for sure, no doubt about it, look at these companies that are in this high-performing portfolio. No questions asked. BMO for sure, going to take a look at Texas Instruments. We've been in that one before, and then GPC. So that's what we got to look at. Let's take a quick look at our beta portfolio and see what's in that. All right, here we go. Now this is nice. Look at this. Blackstone, right? HAS, we've seen that one a couple times. TSM, we've seen that a couple times. So there you go. So that's what we'll look at. Seen this a couple times. Seen this a couple times. Seen this a couple times. That's good enough for me. Let's take a quick look at. That's not what I want. Oh, I know why that is. This source is SCW. Okay. There we go. Alright, now we should be able to see everything. See exactly. Now we got too much. Let's go back. We only want to see past couple months. We don't need to go back 3 years. Alright, here we go. So, just past couple months, looks like consumer defensive failed the most. Looks like health is on a big rise, of course. Real estate, big rise, of course. Now, we've already seen this in the numbers, but seeing something visually, I think, really helps. Like this yellow. What is this? This is tech. See, of course. See this? I mean, this is huge, huge. And this is going to play into what I'm looking for when I'm looking at a new tech stock. Because what we don't want to do is we don't want to get caught buying something at the highest point only to see it drop real big like that. You know, we're not looking for that. Energy is dropped. Consumer cyclicals is dropped. Utilities is dropped. So consumer cyclicals right now, for the most part, look like they have come down some. So that's good. So that means whatever we get into will hopefully be close to the bottom. Won't have to pay too much for it. And yeah, that's it. This one is utilities, industrials. Where's my finance? There we go. And remember, finance is only flat like this because of those insurance companies. My goodness, I'll tell you this: the one thing we won't get into is an insurance company right now. That's not going to happen. We're definitely going to get into some type of bank, you know. And BX looks like a really good choice. So let's take a look here too. I like looking at this just because it kind of shows what the market itself has done over the past few months, just to give us some perspective. So this is April of 2018, and as you can see here, I mean, the market just had a big sell-off, right? This particular company, I'll say, I don't remember which company it was, but the dividend portfolio performed just outstanding. It went crazy, 15% when everything else just died, right? We also have dividend standard deviation, dividend beta, so all the dividend stuff. And then this is our beta portfolio. See this? When the rest of the market just crashes, the beta portfolio it's decent. You know, it's almost 3%. That's pretty cool. All right, and as you can see here, for the past couple months, it's been kind of flat. You know, you've had your outperformers here and there. This is alpha down. This is alpha down. Done pretty well, but it's been kind of flat. You know, it's been moving up, but it's been sort of flat. We have some really outperform alpha there. Down moves there. Up moves. So these are, like I said, the companies that perform best when the market is moving up, and so you see them outperforming. This is May and June. For July, they came down a little bit, which is to be expected. August looks like they're right back up, but also really kind of in line with everything else too. You know, everything in August was up, everything, which is why we have some sell signals, right? And I apologize. This is actually the month of July is really what this is, because this was taken August the 2nd. So this is performance from from July 2nd to August 2nd. So this is July, and then this is August. So in July, everything ran up pretty high. But still, though, that is really why we have some sell signals here. All right, and then we see we have some outperformance here in our September. All right, beta up, beta again, dividend up, beta. All right, so I think that's what we're looking at is a beta portfolio, but we will definitely look at some of those companies that are in the alpha standard deviation camp. I do expect the market to cool off at some point. I mean, we're hitting historical highs. That cannot continue forever. At some point, it will have to come back. But I mean, we can stay up for quite some time. You know, this is, I think, the longest bull market in history so far. So we're going to be up for quite some time. It will cool off at some point, but I think it's a good idea to take advantage where we can. So if we can find some companies that are relatively inexpensive, or at least not super expensive, in those sectors that we were looking at, that will outperform, then I think we're good to go. So that's the game plan. I'll talk to you later.